Let's look at the true cost of a 30-year mortgage and why it costs way more than you think. Everyone buys their house with a 30-year home loan, right? Nope. 11% of us opted to pay less interest by having a shorter payback period. I'll tell you what this means and how it's not too late to fix it if you want to. First things first, let's pick out a house to buy as an example. I'm looking for a house in Los Angeles because I've been looking for a house in LA for years and I haven't found the right one yet. So no matter what, we need 2 bathrooms, and no matter what, we need a house because I'm not a big fan of condo HOAs. Let's check the median home price in LA. Not surprising, it's just over $1 million. So for the price, let's limit this to under $1 million. Yep, almost all the houses in LA disappear. This one's the right price range. I could work with this, but there's too much work needed inside. So let's go northeast. We frequent these areas too. All right, $899, and it looks like a real house with a small yard, and we have 2 baths. Everything looks like that modern millennial gray. I mean, this 780 square feet thing is kind of outrageous, but just to cut to the chase, this is good enough for the example. What's the information they have right up top? Estimated monthly payment, $5,982 a month. So let's just see the breakdown on how they get to this amount. The defaults on Redfin are set to 20% down payment and a 30-year fixed rate loan. This is not a surprise. If you ask Google, 89% of home buyers in the US applied for a 30-year fixed rate mortgage, making it the most popular mortgage option in the country. I think we can do better than this. Also, let's remove the taxes and insurance and such so that we're looking at just the mortgage alone. Here's a bank that offers lower interest rates for borrowing. This shows you something important, which is that the shorter term that you choose, the lower your interest rate is for paying it back. Now let's look at our example. Here's the purchase price of the home that we just looked at. Minus the $179,000 that we saved up to put 20% down, the loan amount is $719,200. With excellent credit, I'm assuming we're going to get the best annual percentage rate. For the most popular 30-year loan, or 360 months, the annual percentage rate is the highest and the monthly payment is the lowest. But here's the part you want to focus on. The house is $899, but the interest paid is over $954,000. So you're paying more for the fee to the bank than you are for the house itself. So it's a little bit less painful on a 15-year loan because the APR is slightly lower. If you only stretch it out to 180 months, so half the time at a lower rate, you're only paying $375,000 in interest. Still kind of stings. Let's check out the 7-year loan. You're only paying $160,000 in interest. Now, look at that monthly payment. It's over $10,000 a month, so it's pretty obvious why most people are going to choose the $4,600 a month option over the over $10,000 a month option. But there are other options, which is buy a lower cost home, et cetera, et cetera. We'll get to the other options later. Instead of using the median home price in LA, let's use the US median home price. We're at $442,000. Again, let's assume we find a good deal and we have excellent credit, so let's just put the purchase price at $400,000 even. If you get a 30-year home loan on a $400,000 house, you are paying more in interest than you are for the house. You don't have a $400,000 house. You have a $744,889 house. Let's just pray that property values don't go down for any reason. This is significant. It's not a little jump here. I mean, you're jumping from $400,000 to $166,000 to under $100,000 in interest. Does this boil your blood like it does for me? It's so much money. Why are we paying so much more to the bank than we are for the house? Literally, the only thing worse than paying the bank more than the price of the house is if you refinanced into another 30-year mortgage and did it all over again. This is the opposite of investing. Your goal and my goal is own assets that pay us. If you're paying more in interest to the bank than the value of your home, you're paying the bank when you want to be the bank. I want to be the bank. I'm reasonable. There are a ton of reasons why most people still opt for the 30-year mortgage despite knowing that they're paying more for the house. And it's the monthly payment trap. So let's take a moment to understand this. A 30-year mortgage spreads the cost over a longer period, making the payment more manageable. And for many, it aligns better with the current financial situation and whatever they need for cash flow. So for a lot of people, the lower initial payments are just more affordable. Another reason is that most people couldn't afford it otherwise. There's a reason that the number right up top on the website that's trying to sell you the house is the monthly payment. They want for you to look at it as affordable. So it's way more affordable than looking at a $1.67 million number. That's the real amount you're gonna pay. If you just break it down and you're like, yeah, it's only $5,000 a month, sure, no problem. In high cost areas like LA, the difference in the monthly payment between the 30-year fixed and the 15-year fixed is really significant. You see this. Another reason is that it feels better. Some borrowers just prefer that perceived safety. It feels better in a longer term mortgage because the thought of the lower payment just feels less financially stressful. $5,000 payment feels better than a $10,000 payment each month if you have to keep paying it for years on end. So you could be okay with this, but if you're like me and you hate paying even 1 penny of interest or fees to anyone ever, unless it's a cash flowing asset, of course, then you have a choice. If you already went down this path, it's not too late to slow down the bank's gravy train. Here's the good news. There are strategies to cut down on the interest you pay, even if you signed a 30-year mortgage contract. You could recast your mortgage, which is making a lump sum payment towards your principal, and then they recalculate the monthly payments for you. To break it down very simply. There's pros and cons to this, but it's different than refinancing. If you haven't bought the house yet, you can try an interest rate pay down. You could pay a little bit more down, because no one's requiring you to do 20% down, right? You can do a little bit more if you can afford to do so, and that will save you thousands over the life of the loan. Another thing you could do is don't buy so much house. If you already bought the house, consider downsizing. If you haven't bought it yet, really think about what you can afford. You have to understand how loan amortization works. That's how they're spreading the payments out over the number of years in the term of your loan. When you look at the payments you're making month by month, you'll notice that at the beginning, most of the payments you're making are applied to the interest. So you're paying the bank first, and then it goes into the value of the house. So the bank still owns the house. Once you get to the end of the first year, on our same example with the $899,000 house, the total amount paid is about $48,000. By the end of the second year, $95,000. You can see that the principal is getting paid down very slowly. Most of the money is going to the bank first, and then later it's getting applied to the equity that you have in the house. At the end of the deal, you have paid $954,000 in interest. Now, let's say you pay an extra $1,000 a month. Here's the breakdown. You get there much quicker. So in year one, $47,719, and you're done by month 223, which is year 18, which means you took 12 years off the life of your loan just by paying $1,000 more each month. If $1,000 is too much of a stretch, or if you have a better use for your $1,000, let's look what happens if you make an extra payment each month of $500. If you pay $500 extra a month, you're done by month 272, which is 22 years, which means you took about 8 years off the life of your loan. Don't get yourself into trouble going down this path. It's not for everyone. You have to call your mortgage servicer or lender and see if they let you do any of this. I mean, they could say yes or no to anything, but really what you're trying to do is apply more to the principal amount of the loan before you just make an extra payment. I mean, they might just apply it to something you don't want them to apply it to, like next month's payment. You want them to apply it to the principal. Some lenders might have a prepayment penalty, or they might charge you a fee for doing that because they want for you to pay over a long amount of time. They don't want you to pay everything up front because that's how they make money, and that's how they make long-term money. Also, read your mortgage contract, or at least go through the table of contents and find the part about any prepayment penalties or fees. If you haven't bought your house yet, check the mortgage contract for any prepayment penalties or fees and try to negotiate them out if you can, or lower them before signing the mortgage contract. So now it's obvious the shorter the loan term, the less you're going to pay in interest overall. But of course, if you stretch your budget too thin, that's not comfortable either, right? You want to make sure you still have room for a comfortable buffer in case of emergencies. Consider the long-term impact to you personally. Higher monthly payments or extra principal payments might limit your financial flexibility. So it's up to you to find the right balance between mortgage payments and your other financial goals. We looked at the breakdown of how your mortgage would look if you shortened it by paying an extra $1,000 a month, and even what it would look like if you paid an extra $500 a month. But maybe this sounds way too extreme. What if you came up with one single extra mortgage payment this year? So say you have a $4,000 mortgage, and you come up with just one extra $4,000 payment that gets applied to principal this year. That's only like 300 something bucks a month. Do you think that would have an impact? Let's see. It makes an enormous impact. It shaves years off of your loan. Just that, just putting one extra payment each year. We might automatically reject this, thinking that $300 is too much more per month, but truly consider, where else would you be using this $300? Somewhere useful, or sometimes do you find that you spend $300 a month or even in a week on something unimportant or even without noticing? Would future you be happier with whatever that money went to, or would future you be happier living mortgage free? The reason I'm so passionate about shortening the life of the loan is because recessions can happen, jobs can go away, work can go away. You don't want your house to go away. So the sooner you can eliminate the risk of your house going away, I think the better. Why not take some of the risk off the table? I hope learning about the impact of just a few extra dollars was as enlightening to you as it was to me when I first learned about it. Let me know your thoughts below, or any other strategies you might have on paying off a mortgage quicker. I bet you can save $300 a month. And if you can't, check out this video on ways to save 300 bucks